Some people play the game of money to get rich. Others play to win. But a select few, the real titans of finance and industry, don't just want to win the game. They want to own the board, write the rules, and become the system itself. These aren't your typical corporate success stories. They're chronicles of brutal ambition, strategic genius, and the relentless pursuit of absolute power. These are the moments in history when a single decision, a cunning maneuver, a ruthless pivot, transformed a mere business into an economic empire. Back in 1872, John D. Rockefeller controlled a huge chunk of America's refined oil, but that just wasn't enough for him. One by one, his rivals in Cleveland stood in his way, a small city of competitors blocking his path to total domination. What Rockefeller did next wasn't just business, it was a declaration of war. He wouldn't just buy his rivals out, he would systematically erase them from the industry in a devastating 40-day campaign. This is the story of how titans didn't just play the game, they rewrote the rules. Today, we're counting down the top 10 most ruthless financial pivots in history, from the robber barons of the Gilded Age to the architects of modern financial collapse. These are the maneuvers that built empires, toppled governments, and forever changed our world. Section 10. Silicon Valley Bank, a modern collapse forged by old hubris. We kick off our countdown not in some smoky backroom of the 19th century, but right in the heart of modern innovation, Silicon Valley. In March 2023, Silicon Valley Bank, SVB, the go-to bank for the entire tech world, blew up in spectacular fashion, becoming the third largest bank failure in U.S. history. This wasn't a slow, painful decline, it was a stunningly fast collapse that happened in just 48 hours. The pivot here was subtle, but deadly. SVB shifted from being a specialized lender into a highly concentrated, poorly managed holder of long-term government debt. It was a move that created a ticking time bomb on its own balance sheet. For years, SVB was thriving as the financial backbone of the startup world. During the boom years of low interest rates, venture capital money flooded into tech startups, and all that cash flooded right into SVB as uninsured deposits. The bank was swimming in cash, but instead of managing this windfall with any kind of caution, it made a fateful pivot. Chasing slightly higher returns, SVB plowed tens of billions of dollars into long-term U.S. Treasury bonds and mortgage-backed securities. Now, on paper, these are safe assets. The problem was their duration. The bank had locked up its depositors' short-term cash into long-term assets that were extremely sensitive to interest rate changes. And here's the ruthless part. This pivot wasn't aimed at a competitor, but at the very idea of risk management. Get this. SVB's own CEO, Greg Becker, had actively lobbied Congress to weaken the post-2008 Dodd-Frank regulations. Between 2015 and 2018, the bank dropped over $500,000 on federal lobbying to raise the bar for stricter oversight from $50 billion to $250 billion in assets. Becker even testified before Congress, arguing that all this oversight was just stifling growth and wasn't necessary for a bank with SVB's supposed low-risk profile. They got what they wanted in 2018, successfully lobbying their way out of the very stress tests that might have flagged the disaster to come. When the Federal Reserve started aggressively hiking interest rates in 2022 to fight inflation, the trap was sprung. The market value of SVB's massive bond portfolio plummeted. At the same time, its tech clients, who were now struggling, started pulling their money out. SVB was caught in a death spiral. To give depositors their money, it was forced to sell its devalued bonds at a multi-billion-dollar loss. On March 8, 2023, the bank announced this staggering loss and a desperate plan to raise more cash. That announcement triggered a full-blown panic. In a single day, customers tried to withdraw an astonishing $42 billion. By March 10, it was all over. Regulators seized the bank. SVB's pivot was a masterclass in modern hubris, ignoring basic financial principles and tearing down the guardrails meant to prevent catastrophe, all for a few extra basis points. It was a stark reminder that even today, the seeds of financial ruin are sown with the same old tools of greed and negligence. Section 9. Bank of Credit and Commerce International, BCCI, the criminal sovereign from a modern bank that broke the rules of risk. We go back in time to a bank that was seemingly founded to break the rules. The Bank of Credit and Commerce International, or BCCI, wasn't just a corrupt bank. It was a global criminal enterprise disguised as one. Its pivot was shifting from a legitimate financial institution for developing nations into a sophisticated, multi-billion-dollar machine for money laundering, bribery, and fraud on a scale the world had never seen. At its peak, BCCI operated in over 70 countries, had assets over $20 billion, and became known to investigators as the Bank of Crooks and Criminals International. Founded in 1972 by a charismatic Pakistani financier named Agha Hassan Abedi, BCCI sold itself as a new kind of bank, one dedicated to the little guy in the developing world. That was its cover story. The bank's true, ruthless pivot was its corporate structure, which was deliberately designed from day one to dodge regulators. Think of it as a global spider's web of shell companies, offshore accounts, and secrecy havens, all so convoluted that no single country's regulators could ever see the full picture. This let BCCI operate like its own country, unbound by any national laws. The bank's client list was a who's who of the world's most notorious figures. It laundered money for dictators like Panama's Manuel Noriega, terrorist groups like Abu Nidal, and the Colombian Medellin drug cartel. Even the CIA later admitted to using BCCI to shuffle money around for covert ops. The ruthless tactic was the system itself, a global, decentralized network built for crime. For example, the bank secretly and illegally bought a major U.S. bank, First American Bancshares, giving it a backdoor into the American financial system. This let illicit funds flow right through the heart of the global economy. The fraud was everywhere. Auditors eventually discovered the bank was using secret ledgers and untraceable accounts to hide colossal losses and just make up profits for years. BCCI was basically a giant Ponzi scheme, using new deposits to pay off earlier ones to keep up the illusion of success. In July 1991, after a years-long global investigation, the House of Cards came down. Coordinated raids in 7 countries shut BCCI down practically overnight. The collapse wiped out the savings of over 1 million depositors, many of them ordinary people in poor countries who had trusted the bank's noble mission. Total losses were estimated at over $10 billion. BCCI's pivot from a bank to a criminal empire showed just how financial innovation could be twisted into a weapon, creating an institution that operated beyond the law, leaving a trail of devastation behind it. Section 8. Enron and AMP, Parmalat, the twin titans of deceit. If BCCI was a bank built for crime, our next entry perfected the art of committing crime inside a legitimate-looking business. In the early 2000s, it's a tale of 2 companies on opposite sides of the Atlantic, Enron in the US and Parmalat in Italy, who executed parallel pivots that made their names synonymous with corporate fraud. Their ruthless maneuver was to transform from real businesses, one in energy, the other in dairy, into elaborate financial illusions, using accounting tricks to build empires of pure fiction. Enron, a Houston-based energy company, was once the 7th largest corporation in America. Its pivot started in the 90s as it moved from just moving natural gas to becoming a trading powerhouse. But its most sinister shift was its embrace of mark-to-market accounting and special-purpose entities, or SPECs. Mark-to-market let Enron book potential future profits as actual income today. It was like counting the cash from a lemonade stand you were maybe thinking about opening next summer. The SPECs were even worse. Think of them as secret corporate credit cards. Enron created hundreds of these off-the-books companies to hide its mountains of debt and failed investments. This pivot turned Enron from an energy company into a complete black box. Its financial statements were pure fantasy, designed to fool investors and pump up its stock price. Meanwhile, across the ocean, Parmalat, a global dairy and food giant, was running a strikingly similar playbook. Known as Europe's Enron, the company looked like a stable, family-run Italian success story. Its ruthless pivot was creating a maze of over 200 offshore subsidiaries, a web designed for one thing: to hide the company's real financial state. For over a decade, Parmalat systematically faked its accounts, creating imaginary assets to cover up more than $10 billion in hidden debt. The fraud was both audacious and, in the end, shockingly clumsy. The whole scheme unraveled in late 2003 when the company claimed to have a $4.9 billion bank account with Bank of America. When auditors checked, Bank of America confirmed the account didn't exist, the document proving there was a laughably crude forgery. The outcomes were catastrophic. Enron filed for bankruptcy in late 2001, wiping out over $70 billion in shareholder value and leaving thousands of employees jobless with worthless pensions. Its auditor, Arthur Andersen, once one of the most respected accounting firms in the world, was found guilty of obstruction of justice for shredding Enron documents and collapsed. Parmalat's 2003 collapse was Europe's largest bankruptcy, exposing a €14 billion hole in its books. These twin scandals exposed a profound failure of corporate ethics. Their pivots weren't about crushing a competitor, but about deceiving the entire world. They showed how the complex machinery of modern finance could be hijacked to build corporate mirages, with devastating real-world consequences. Section 7. Long-term capital management: the arrogance of genius. While Enron and Parmalat were built on lies, our next subject was built on an unshakable belief in its own genius. Long-term capital management, or LTCM, was a hedge fund like no other. Founded in 1994, this wasn't just any fund, it was started by a dream team of Wall Street's brightest minds, including the legendary trader John Meriwether and two future Nobel Prize winners, Myron Scholes and Robert Merton. LTCM was a monument to intellectual arrogance. Its pivot was to take complex, supposedly risk-free trading strategies and supercharge them with staggering amounts of borrowed money, creating a financial weapon of mass destruction that nearly took down the entire global financial system. LTCM's core strategy was called arbitrage. Basically, their incredibly complex mathematical models would spot tiny, temporary price differences between related things, like a new US Treasury bond and an older one. They would bet that these prices would eventually converge. The profit on any one trade was minuscule, fractions of a penny. To make real money, they needed two things: massive volume and massive leverage. And boy, did they have both. By the start of 1998, the fund had about $5 billion in capital but had borrowed over $125 billion. It was leveraged 30 to 1. On top of that, its total exposure through complex derivatives was over $1.25 trillion, about 5% of the entire global market at the time. The pivot here wasn't a single event, but a gradual escalation of hubris. For the first few years, the strategy worked perfectly, delivering jaw-dropping returns over 40% a year. The partners believed their models were infallible. They were the smartest guys in the room, and they thought they had created a literal money-printing machine. The ruthless part was their complete dismissal of the one thing their models couldn't predict: human panic. Then, in August 1998, their perfect world shattered. Russia devalued its currency and defaulted on its debt. This triggered a global flight to quality, as terrified investors everywhere dumped anything risky and fled to the safest investments they could find. This was the one thing LTCM's models said could never happen. Instead of converging, the price gaps they were betting on blew wide open. The fund began hemorrhaging money at a terrifying rate. In August 1998 alone, LTCM lost $2.1 billion, 44% of its capital. By September, it was in a death spiral, losing hundreds of millions a day. The Federal Reserve was terrified. LTCM was so huge and so connected to every major bank on Wall Street that its collapse could trigger a chain reaction and freeze global credit. So on September 23, 1998, the New York Fed orchestrated an unprecedented private bailout. A group of 14 major banks, the very firms that stood to lose the most, were strong-armed into injecting $3.65 billion to take over the fund and unwind its positions without causing Armageddon. LTCM proved a new kind of risk, not from a company acting like a state, but from a private firm becoming so important that its failure threatened everyone. It was a terrifying dress rehearsal for the crisis that would come a decade later. Section 6 to 1 MDB. The Sovereign Slush Fund. Our next pivot takes the idea of sovereign power to its most literal and corrupt conclusion. This isn't the story of a company acting like a state, it's the story of a state-owned fund being plundered like a personal piggy bank. The One Malaysia Development Berhad, or 1MDB, scandal wasn't just mismanagement, it was one of the biggest kleptocracy cases in modern history. Started in 2009 by Malaysian Prime Minister Najib Razak, 1MDB was supposed to be a sovereign wealth fund to promote economic development. Its real pivot was its immediate transformation from a national investment tool into a massive, multi-billion-dollar slush fund for corrupt officials, financiers, and their friends. The mastermind behind it all was a flamboyant Malaysian financier named Joe Low. Though he had no official title, Low was the guy who orchestrated the systematic looting of the fund. The tactic was breathtakingly simple and massive in scale. 1MDB would raise billions by issuing government-backed bonds, and then, using a complex web of offshore shell companies in secret bank accounts, a huge chunk of that money would just disappear. Between 2009 and 2015, it's estimated that over $4.5 billion was stolen from the fund. This wasn't just greed, it was the weaponization of state finance for personal and political gain. Hundreds of millions of dollars allegedly flowed right into Prime Minister Najib Razak's personal bank accounts. That money was reportedly used to fund a lavish lifestyle for his wife, pay off political allies, and boost his 2013 re-election campaign. And the stolen money? It funded a lifestyle for Joe Low and his friends so absurd it sounds like something out of a movie. A $260 million yacht, a $35 million private jet, mansions in Beverly Hills and Manhattan, and millions spent on lavish parties with celebrities. They even gave Leonardo DiCaprio a $3.2 million Picasso painting as a gift, and model Miranda Kerr got millions in diamonds. Global financial institutions were right there in the thick of it. Goldman Sachs played a key role, earning an astronomical $600 million in fees for arranging 3 bond deals that raised $6.5 billion for 1MDB. Prosecutors later alleged that Goldman ignored glaring red flags while billions from those deals were being embezzled. The 1MDB scandal is a chilling modern echo of the old Medici, where the lines between state finances and personal power completely vanish. The fund's pivot from an engine of development to an engine of grand corruption turned Malaysia's national wealth into a private treasure chest. The fallout led to the historic ousting of Najib Razak's government in 2018, and global investigations are still entangling the vast criminal network he and Joe Low created. Section 5. Lehman Brothers, the harbinger of Armageddon. Remember that dress rehearsal for a global collapse with LTCM? Well, a decade later, Lehman Brothers delivered the real thing. The investment bank's pivot in the mid-2000s was a full-throated, reckless dive into the absolute riskiest corner of the U.S. housing market: subprime mortgages. This wasn't just a business decision, it was a bet the firm gambled that ended up triggering the worst global financial crisis since the Great Depression. The story of Lehman's fall is about how an entire institution can pivot toward its own destruction, blinded by short-term profits and a culture of extreme risk. Lehman Brothers was a 158-year-old titan of Wall Street. In the years leading up to 2008, it became a central player in the housing bubble. Its business model was to buy up mortgages, especially subprime loans made to people with bad credit, and package them into complex securities called MBSs and CDOs, which it then sold to investors around the world. The ruthless pivot happened when Lehman went from being a middleman in this process to an addict high on its own supply. As the housing market got crazier, Lehman found it harder to sell the riskiest, junkiest parts of these securities. Instead of pulling back, it made a fatal choice. It started keeping these toxic assets on its own books. The bank was grotesquely over-leveraged. By 2007, it had around $640 billion in assets balanced on only $22 billion in equity, a leverage ratio over 30 to 1. That meant a tiny 3–4% drop in the value of its assets would wipe the entire company off the map. The culture, driven by CEO Dick Fuld, was one of unwavering aggression, where internal warnings were ignored and risk was seen as a one-way street to riches. In 2007, even as the housing market started to crack and the bank shut down its own subprime lending unit, Lehman kept doubling down, holding on to the worst of the mortgages for itself, chasing the huge profits they promised. When the housing bubble burst in 2007 and 2008, the value of these toxic assets cratered. Lehman was trapped. It couldn't sell them without realizing catastrophic losses, and its insane leverage meant those losses were life-threatening. After frantic, failed negotiations to find a buyer, the US government made the momentous decision not to bail out the firm. On September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy, the largest in US history, with over $600 billion in assets. Its collapse was the financial equivalent of a nuclear bomb. It instantly froze global credit markets, vaporized trillions in wealth, and plunged the world economy into a deep recession. Lehman's pivot into a dumping ground for toxic waste wasn't just a corporate failure, it was an act of systemic arson that showed how a single investment bank could hold the entire global economy hostage. Section 4. Ray Kroc and AMP. McDonald's, the hamburger heist from the gleaming towers of Wall Street, we pivot to the humble hamburger stand. The story of McDonald's is often sold as a classic American success story, but the truth is a lot more brutal. It's the story of a ruthless pivot made not with complex derivatives, but with a contract, a handshake, and a cold-hearted betrayal. This is how Ray Kroc, a 52-year-old milkshake machine salesman, didn't just franchise the McDonald's concept. He hijacked it from its visionary founders, the McDonald brothers. In 1954, Richard and Maurice McDonald were running a wildly successful restaurant in San Bernardino, California. They had perfected a revolutionary, speedy service system, a limited menu and an assembly line kitchen that was the blueprint for modern fast food. Ray Kroc, who was selling them milkshake mixers, saw the genius in their system and envisioned a nationwide empire. He convinced the brothers to let him be their franchise agent. But the initial deal was restrictive. Kroc was constantly frustrated by the brothers' obsession with quality and their refusal to make changes. The first ruthless pivot came from a financial wizard named Harry Sonneborn, who told Kroc the secret to real power. You are not in the burger business. You are in the real estate business. So Kroc changed his entire strategy. Instead of just franchising the restaurant concept, Kroc's company started buying or leasing the land the restaurants were built on. He then became the franchisee's landlord. This gave him a massive, steady stream of income, and more importantly, ultimate leverage. If a franchisee stepped out of line, Kroc could just terminate their lease and kick them out. He had completely outmaneuvered the brothers by controlling the very ground their empire was built on. By 1961, the relationship was toxic. Kroc wanted total control. He pressured the brothers to sell him the entire company, name and all. Tired of the constant fighting, they agreed, for a price of $2.7 million. But they made one final request, a handshake agreement for a 1% royalty on all future profits. Kroc agreed. But when it came time to sign the actual contract, the royalty clause was nowhere to be found. Kroc claimed his financiers wouldn't approve the deal with it in there, but he swore he would honor the verbal agreement. He never paid them a single dime. That verbal promise, if honored, would be worth hundreds of millions of dollars a year to the McDonald brothers family today. But the final act of ruthlessness was the most personal. As part of the sale, the brothers were allowed to keep their original San Bernardino restaurant, but they had to rename it, the Big M, in a move of pure spite. Kroc opened a brand new McDonald's just 1 block away and gave the manager a single order: run them out of business. Within a few years, the Big M was closed. Ray Kroc's pivot wasn't just about business strategy, it was a personal conquest. He didn't just want to build an empire, he wanted to erase its true creators from the story and claim it all for himself. Section 3. Salomon Brothers forging the weapons of a future crisis. So we've talked about the 2008 crisis, but where did those financial weapons of mass destruction actually come from? For that, we have to go back to the 1970s and 80s, and to Salomon Brothers, the undisputed king of the bond market. This was a firm defined by an aggressive, eat-what-you-kill culture. Its historic pivot was the invention and popularization of the mortgage-backed security, MBS, a revolutionary financial tool that transformed American housing but also planted the seeds of the crises to come. Before Salomon, the mortgage market was simple. A bank would lend money to a homebuyer, then hold that loan for 30 years, slowly collecting payments. This tied up huge amounts of capital, limiting how many new loans a bank could make. A team at Salomon, led by a brash and brilliant bond trader named Louis Ranieri, saw a huge opportunity. Ranieri, who famously coined the term securitization, came up with the idea of buying up thousands of individual mortgage loans, bundling them together into a giant pool, and then selling slices of that pool to investors as a new type of bond. This was the mortgage-backed security. This pivot was a revolution. It created a liquid market for mortgages, letting banks sell off their loans, get their cash back immediately, and make new loans. In theory, it was a win-win-win. Banks had more capital, more people could get home loans, and investors had a new, high-yield asset to buy. Ranieri and Salomon lobbied Congress relentlessly to pass laws that would remove any barriers to trading these new securities, unleashing them on the financial world. The ruthlessness here was in the aggressive, risk-ignorant culture that Salomon celebrated. The firm became a place of big swinging dicks, as famously described in Michael Lewis' book Liar's Poker, where traders took huge risks for huge bonuses, with zero regard for long-term consequences. This culture eventually blew up in a massive scandal in 1991. It was discovered that a top trader had been rigging U.S. Treasury auctions, submitting fake bids to let the firm illegally corner the market on government bonds. The scandal nearly destroyed the firm, leading to a $290 million fine and forcing its CEO to resign. Warren Buffett himself had to be brought in as chairman to save the company from collapse. Salomon Brothers was eventually bought out and its name disappeared, but its true legacy was the financial technology it unleashed. The MBS, a tool designed to spread risk, became a machine for concentrating and hiding it, as the 2008 crisis would so devastatingly prove. Salomon's pivot didn't just make the firm dominant, it fundamentally rewired the DNA of global finance, creating complex weapons that other, equally ruthless players would later use to bring the system to its knees. Section 2. Cornelius Vanderbilt, the Commodore who commandeered America before Wall Street cooked up financial weapons, the original titans, the robber barons, built their empires with steel and steam. And none were more formidable, more utterly ruthless, than Cornelius, the Commodore, Vanderbilt. Rising from a humble ferry operator, Vanderbilt built a shipping and railroad empire that made him one of the wealthiest men in American history. His great pivot was shifting from competing in the transportation industry to becoming the industry, consolidating America's railroads into a monopoly that he alone controlled. Vanderbilt started out in the steamboat business, which is where he earned his nickname and perfected his brutal tactics. He was a master of the price war. He'd enter a market, slash his fares to practically nothing, sometimes even offering free passage, and just bleed his competitors dry until they either went bankrupt or paid him to go away. In one famous fight on the Hudson River, his rivals paid him a huge sum just to take his boats elsewhere. In the 1860s, at an age when most men were retiring, Vanderbilt saw that the future was not on water, but on rails. He pivoted his entire fortune and focused to railroads. He didn't just invest, he conquered. He started buying up railroads around New York City, aiming for total consolidation, a single seamless network under his command. His most ruthless tactics were designed to crush anyone in his way. He'd manipulate stocks to seize control of companies and fought legendary corporate battles, like the Erie War, against speculators Jay Gould and James Fisk. But his most audacious move came in 1869. He wanted to complete his control over the critical rail link between New York and the Midwest. The last piece of the puzzle was the only rail bridge into New York City, owned by a rival. When they refused to sell, Vanderbilt showed them what real power looked like. He simply closed the bridge. He cut off all other railroads from entering the nation's most important city, strangling commerce and creating chaos. The stock of the rival railroads plummeted, and their owners came crawling back to Vanderbilt, defeated, begging him to reopen the bridge. He'd made his point. He soon controlled the entire network. By consolidating these lines, Vanderbilt created one of America's first giant corporations and controlled a vital artery of the economy. He could dictate shipping prices for almost any good, giving him immense power over every other industry. At the height of his power, his fortune was equal to about 1/9 of all U.S. currency in circulation. Vanderbilt's pivot wasn't just about getting rich, it was about achieving economic sovereignty. He didn't just own a business, he owned the infrastructure of a nation, forcing both competitors and the public to bend to his will. Section 1. John D. Rockefeller and AMP, Standard Oil, the sovereign of oil, and here we are. Number 1. The man and the company that represent the absolute pinnacle of the ruthless financial pivot. John D. Rockefeller and the Standard Oil Company didn't just dominate their industry, for a time, they were their industry. The pivot was from being one of many oil refiners in a chaotic market to becoming a near-total monopoly that controlled over 90% of America's oil, dictating the flow of the nation's energy and amassing power that rivaled the U.S. government itself. Rockefeller, like Vanderbilt, saw that the real power was in controlling the infrastructure. He understood that in the oil business, the bottleneck wasn't drilling for oil, but refining and transporting it. His plan was one of total, systematic annihilation of his competition. His primary weapon was the secret rebate. Because he controlled such a massive volume of oil, Rockefeller went to the railroads and negotiated secret, preferential shipping rates that were way lower than what any of his rivals paid. But here's the truly diabolical part. He even negotiated drawbacks, where the railroad would give him a cut of the fees they charged his competitors. It was a death sentence for any other refiner. They were being charged more to ship their product, and a chunk of that fee was going right into Rockefeller's pocket. This set the stage for his most infamous campaign, the Cleveland Massacre of 1872. Over just a few weeks, Rockefeller went to the 24 other refiners in Cleveland and gave them an ultimatum: sell out to me at my price, or be destroyed. He showed them his secret railroad contracts, proving that he could ship oil so cheaply he could undersell them into bankruptcy without breaking a sweat. One by one, they gave in. In just over a month, he had absorbed most of his direct competitors, and Standard Oil controlled a quarter of the entire U.S. industry. From there, he took his war plan nationwide. He used price wars, industrial espionage, and control over oil pipelines to choke off supply to any refiner who dared to resist. He would buy up land just to physically block competitors from building their own pipelines. It was a scorched earth campaign, absorbing rival after rival into his ever-growing trust. By the 1880s, his conquest was nearly complete. Standard Oil refined almost all of the nation's oil, controlled its pipelines, and set the price for kerosene, the fuel that lit up America. Rockefeller's pivot from competitor to sovereign was absolute. He had achieved what no one else had. He had tamed a wild, cutthroat industry and bent it to his will, creating order and efficiency, though by brutal means. And while he did drive down the price of kerosene, he also crushed countless businesses and built a monopoly so powerful that it spurred the creation of America's antitrust laws, which led to Standard Oil's breakup by the Supreme Court in 1911. John D. Rockefeller's pivot remains the ultimate blueprint for ruthless ambition, a masterclass in how to turn a company from a player in the market into the market itself. From the oil fields of Pennsylvania to the trading floors of New York, from Silicon Valley server rooms to the offshore accounts of a rogue state, the pattern is the same. These 10 stories are more than just history, they're a timeless playbook of power. They show us that for some, the desire isn't just for wealth, but for dominion. It's the ambition to pivot from just earning a living to taking active control over markets, over rivals, and sometimes over the very economies that sustain us all. The tools might change, from railroad rebates to mortgage-backed securities, but the underlying drive is eternal. The titans we've talked about saw the systems of their time not as rules to follow, but as structures to be captured and redesigned for their own benefit. They became economic sovereigns, wielding power that could rival governments and reshape society. And while many of their empires eventually crumbled, brought down by their own hubris or the public they sought to control, their legacy endures. The ruthless pivot is not a relic of the past, it is a fundamental, and often terrifying, force in the eternal game of money and power. If you were fascinated by these stories of ambition and power, make sure to subscribe and hit the notification bell for more deep dives into the minds of history's most influential figures. And check out our other video on the rise and fall of the Medici Bank to see how this playbook was written centuries ago. Thanks for watching.